Welcome back to the Daily Crypto Deep Dive. What if this crypto crash is not just a disaster? What if this is actually the kind of opportunity that people only recognize after the market has already moved? Because right now, that is the real question. Bitcoin has been smashed back toward the $58,000 to $60,000 area. Ethereum has been hit even harder. Solana, XRP, Dogecoin, the wider altcoin market, crypto stocks, strategy, miners, everything tied to this sector has been under pressure. And when you look at your screen on days like this, it feels horrible. It feels like the bull market is dead. It feels like every single crypto influencer was wrong. It feels like the whole thing was overhyped again. Before we get into today's deep dive, a quick reminder. We've teamed up with Kraken, and if you are trading crypto or thinking about getting started, using our Kraken link is one of the best ways to support the show. Kraken is one of the biggest and most trusted crypto exchanges in the world, and if you sign up through our link, it helps keep Crypto News Today going. We also have a 20 XRP giveaway for listeners who sign up using the Kraken link, so make sure you check the link in the description. As always, this is not financial advice. Crypto is risky, prices can move fast, and you should only invest what you can afford to lose. But if you are going to use an exchange, and you want to support the show at the same time, the Kraken link is in the description. Right, let's get into it. Because today's episode is about whether this crypto reset is actually the opportunity everyone misses. Today, we are going to look at this like investors. Because if Bitcoin is sitting around $58,000 and it simply goes back to $85,000, that is not some wild fantasy price target. That is not even talking about a new all-time high. That is just talking about a recovery back to a level Bitcoin has already shown it can trade at. But from $58,000 to $85,000, that is roughly a 47% gain. Now stop there for a second. Because in crypto, people almost dismiss that. They say, well, Bitcoin just went back to where it was. But in the real world, a 47% gain is enormous. If your pension went up 47%, you would not just casually shrug it off. If your stocks and shares went up 47%, you would not say, nothing happened. If your house went up 47%, you would be telling everybody at work and everybody at the bar. A 47% gain is serious money. And when you compare it to normal long-term investing, that is where this episode gets interesting. A lot of pension projections use annual growth assumptions around 2%, 4%, 6%, or 7%, depending on the investment mix and the way the provider calculates the projection. Pension funds can do better than that in strong periods. And some long-term growth funds have averaged around 5% to 8% over certain periods, especially for younger savers who are further from retirement. But the key point is this: normal wealth building is slow. At 5% a year, it takes nearly 8 years to grow your money by 47%. At 7% a year, it still takes nearly 6 years. At 4% a year, it takes almost 10 years. And at 2% a year, it takes nearly 20 years. That is the perspective. A Bitcoin recovery from $58,000 to $85,000 would be the kind of move that a normal pension saver might wait 6, 8, 10, maybe even 20 years for, depending on the return environment. And in crypto, that move could happen in months. Now, that does not mean it will happen. This is not financial advice. Nobody knows where Bitcoin goes next. Bitcoin could go lower. CoinDesk has already pointed out that if certain historical retracement patterns play out, Bitcoin could still fall toward the $48,000 area. So this is not a go all-in message. This is not a Moonboy episode. This is not me saying the bottom is definitely in. But this is the moment where serious investors ask a different question. They do not ask, am I scared? Everyone is scared. They ask, is the asset broken or is the price broken? That is the difference. If the asset is broken, you leave it alone. If the price is broken, that is where opportunity lives. So let's look at Bitcoin. Has the network stopped working? No. Has the fixed supply changed? No. Has the 21 million cap disappeared? No. Have institutions completely abandoned Bitcoin forever? No. Has crypto regulation vanished? No. Has the long-term thesis of digital scarcity disappeared? No. What has changed is the price, the flows, the mood, and the macro backdrop. And that matters, because Bitcoin is not trading in a vacuum anymore. The market today is much more mature than it was in 2017 or 2021. We have ETFs, we have institutions, we have public companies holding Bitcoin, we have derivatives markets, we have macro funds, we have traders comparing Bitcoin against the NASDAQ, the dollar, bond yields, AI stocks, commodities, and liquidity conditions. That makes Bitcoin bigger, but it also makes it more exposed to the same forces that hit other risk assets. When rates are expected to stay higher or even rise, risk assets struggle. When the dollar strengthens, Bitcoin struggles. When tech stocks sell off, Bitcoin often sells off with them. When investors are pulling money out of crypto ETFs, Bitcoin struggles. And right now, that is exactly the environment we are in. Crypto is not just falling because someone posted a bearish chart on Twitter. It is falling because capital has moved away from speculative assets. The market has been choosing cash, dollars, stablecoins, commodities, AI-linked stocks, and traditional assets over crypto. CoinDesk made an interesting point. Bitcoin is down badly. Ethereum is down even more. Strategy is down badly as well. And the total crypto market cap has fallen back toward levels not seen since before the Trump election rally. But stablecoins have held up much better. That tells you something important. Money has not necessarily left crypto completely. A lot of it is sitting on the sidelines. And that is a huge distinction. If people had lost faith completely, stablecoin supply would be collapsing. Exchanges would be emptying out. The whole system would be shrinking aggressively. Instead, what we are seeing is risk being parked. Traders are not necessarily leaving forever. They are hiding. They are waiting. They are saying, I do not want Ethereum today. I do not want Solana today. I do not want meme coins today. I want dollars. I want USDT. I want USDC. I want to wait until the dust settles. That is painful in the short term, but it also means there is dry powder. And dry powder matters. Because when markets turn, they do not wait for everyone to feel comfortable. That is the horrible truth about investing. The best opportunities usually feel disgusting when they appear. Nobody rings a bell at the bottom. You do not get a message saying, "Congratulations, the worst is now over. Please invest safely." What usually happens is this. The headlines are terrible. People are exhausted. Influencers disappear. YouTube views drop. Retail gives up. Everyone starts saying crypto is dead. And then quietly, the strongest hands start accumulating. CoinDesk reported that every Bitcoin wallet cohort had shifted into accumulation for the first time this year, according to Glassnode data. That does not guarantee a bottom, but it is exactly the kind of thing you want to pay attention to when price is ugly and sentiment is awful. Because this is how markets transfer wealth. In the hype phase, late buyers buy from early buyers. In the panic phase, patient buyers buy from forced sellers. And right now, the question is whether we are in panic or whether this is still just the middle of a deeper bear market. That is where we have to be honest. Bitcoin may not have bottomed. A 47% rebound opportunity sounds amazing, but there is a reason it exists. If Bitcoin were safe, calm, predictable, and guaranteed to go back to $85,000, it would not be sitting near $58,000 in the first place. The market is giving you potential upside because it is also giving you real risk. That risk includes further ETF outflows. It includes a stronger dollar. It includes higher rates. It includes weakness in tech stocks. It includes strategy pressure. It includes liquidation cascades. It includes the possibility that Bitcoin does not just recover quickly, but chops sideways for months and bores everyone to death. That is why position sizing matters. The opportunity is not throw everything at it and hope. The opportunity is understanding the asymmetry. If someone buys Bitcoin at $58,000 and it goes back to $85,000, that is around 47%. If it goes back to the previous cycle peak above $126,000, that is a much bigger move again. But if it falls to $48,000 first, that person is sitting through another painful drawdown before the opportunity pays off, if it pays off at all. So the real question is not just, can Bitcoin go back up? The real question is, can you emotionally and financially survive the path? That is what separates investors from gamblers. A gambler sees 47% upside and thinks, I need to go all in. An investor sees 47% upside and thinks, how much can I allocate where I can survive being wrong? That is the mature way to look at this market. And this is where the pension comparison is powerful. A pension is boring on purpose. You contribute every month. You do not check it 40 times a day. You let time and compounding do the work. The whole model is patience, diversification, tax advantage, and long-term growth. Crypto is the opposite emotionally. It is fast, volatile, noisy, stressful, and full of people screaming price targets. But the opportunity comes from that volatility. If Bitcoin can deliver several years of pension-style growth in a single recovery, the price of admission is that it can also deliver several years of pension-style pain in a single month. That is the trade-off. And this is why I think the right message for listeners is not panic, and it is not hype. It is preparation. If you believe in Bitcoin long-term, this is the kind of zone where you should have a plan. Not a fantasy, not a panic button, a plan. What price levels matter to you? How much are you willing to buy? Are you buying Bitcoin only, or are you going further out on the risk curve into Ethereum, Solana, XRP, and altcoins? Are you keeping cash ready in case Bitcoin goes lower? Are you using dollar cost averaging so you are not trying to perfectly call the bottom? Are you avoiding leverage? Are you keeping your crypto secure? Are you accepting that this could take longer than you want? Because the biggest mistake people make in crypto is that they want life-changing upside with no discomfort. That does not exist. The discomfort is why the upside exists. When Bitcoin is ripping, everyone wants it. When Bitcoin is hated, nobody wants it. But mathematically, your future return is better when you buy weakness than when you chase euphoria. That does not mean every dip is a buy. Some dips are warnings. Some assets never recover. Some altcoins go down 90% and stay there. But Bitcoin is different because it is the benchmark asset of the entire crypto market. If Bitcoin is not dead, then extreme weakness deserves attention. And right now, Bitcoin is battered, but not dead. Ethereum is battered, but not dead. Crypto is battered, but not dead. The market has reset. The tourists are gone. The leverage has been punished. The weak narratives are getting exposed. And the serious question now is whether this reset becomes the foundation for the next opportunity. So here is the verdict. If you are looking at this market and feeling fear, that is normal. But fear alone is not analysis. A Bitcoin move from $58,000 back to $85,000 would be roughly a 47% gain. In pension terms, that could represent 6 to 10 years of normal compounding compressed into one recovery move. That is why this market still matters. But that opportunity comes with serious risk. Bitcoin can go lower. The macro backdrop can stay ugly. ETF outflows can continue. Crypto can remain out of favor for longer than people expect. So the answer is not to be reckless. The answer is to be awake. Because if Bitcoin does recover, a lot of people will say it was obvious. They will say they knew $58,000 was cheap. They will say they were always bullish. But the truth is, the opportunity only feels obvious after the move has already happened. Right now, it feels uncomfortable. And that is why this moment matters. This might not be the bottom, but it might be the kind of market where future gains are made. And as always, protect yourself. Think long-term. Do not use money you cannot afford to lose. And make your own decisions. We will see you at the top.